Welcome to the Grow Your Business and Grow Your Wealth podcast with Gary Heldt. Gary is an expert in helping business owners put together a plan that will provide a better future for their businesses, themselves, and their families. On the podcast, Gary interviews other professionals who share his vision, and together they share secrets and strategies any business owner can use to build a better financial foundation for your business and your life.
Welcome back to the podcast. This week our guest is Matt Ruttenberg, who is the CMO and Shareholder of Life, Inc. Welcome, Matt.
Hey, Gary. How you doing? Thanks for having me on.
Great. So, Matt, what got you into finance?
Well, that's a good question. I'm a third generation financial expert, if you will. My grandfather, my father, and I started off as a financial planner. I did that straight out of college, worked with my dad for years, and did that for 15 years, I'd say. Ended up selling that about 3 years ago. Wanted to get into more of a defined, instead of being a generalist, I wanted to be a specialist. And I've been doing 401ks for years, but I was doing it from the not from the administration side, more from the investment side and education. More of if I had a business client, I was helping them with the 401k too. And part of what I did is I paired off my 401k business and merged with Life Inc. Retirement Services, where I'm at now. And we're basically focused on small businesses, but doing it from a high level, not just offering 401k plans, but we're doing it from a very high level, like you are a large entity, and creating custom plans instead of just turnkey prototype plans. So been in the business for a long time, started in the 401k business probably 10 years ago, but been in the industry for, I guess, 18 years now. So long time.
So, now that you're specializing in 401ks and things, what is it about a 401k that businesses, why they tend to flock to the 401ks?
I mean, the 401ks are so versatile. It's not a turnkey. Anything that has 401k at the end of it has more compliance needs, but it also is because there's more versatility. There's a little bit more gray area when you build and mold and design your plan. If your retirement has IRA at the end, you can consider it like a simple IRA or a SEP IRA. Those are pretty turnkey. There's nothing you can really change on it. But if you really want to get into the high level plan design and get into saving as much as you can in both contributions and taxes, with tax planning, with goes in your side of it, a 401k is absolutely necessary. Even if you're a solo entrepreneur, comparing a SEP to a solo 401k, the solo 401k is drastically better, just from the way you calculate the contributions from that point alone, and then being able to stack different kind of plans on top of that. It's very, very versatile and vast what you could do with 401k.
So what are some of the common mistakes that you see people making when it comes to having a 401k or starting one up?
And I think it goes to kind of what we were talking before we started recording. There's a lot of turnkey options out there, a lot of plug and play. They're called prototype plan documents, where this is the plan document. It's already been filed with the IRS. You're just going to plug your name into it, and that's it. There's not a lot of customization or versatility with a prototype plan. And these are the ones that maybe the payroll companies offer, or ones you see online that are easy to implement. They're easy to implement, but they're also, you're going to get what you pay for kind of situation. I always compare it to, if you're a business owner, are you going to want to work with like H&R Block? Or you're going to want to work with someone like you, where there's actually, you're going to have a little bit more of an investment involved, but it's going to reap the rewards down the road drastically. And so that's just one of them. The other thing is waiting too late to really start looking into it. Deadlines, we're telling folks right now, start looking into it, because what you're doing in this tail end of 2022, you might need to adjust your income because with the Secure Act in 2019, there's a lot of changes to the 401k world, retirement plans in general. And one of them was being able to implement and contribute towards the employer portion of the 401k plan all the way up until the day you file. So we're doing last minute plan designs right now to get these things implemented for profit sharing for 2021 right now. And being able to just start the conversation a year, 2 years ahead, get ready, start having the conversation, because deadlines come up and all of a sudden you could be losing tens of thousands of dollars in taxes by not just asking questions.
Right. Now, with 401k plans, what kind of compliance work do they have that has to be done?
Yeah, good question. So there's, like I said before, when 401k is at the end of it, so 401k, safe harbor 401k, administration is required, and there's annual testing involved, and there's a 5,500, 9 times out of 10 that needs filed, unless you're a solo entrepreneur and you have less than $250,000 in there. But the annual testing, and there's multiple tests. The most popular is the ACP, ADP, but really I call them fairness tests. The IRS and Department of Labor, they want the plan to be fair to the employees. The employees is the focus here, and being able to, and they basically want you to create a plan that's fair to them and you as the employer.
Right. So I guess, because again, I've heard all kinds of different nightmares and stuff like that, where employers have these prototype, 401k set up and things like that, and they're contributing, but they're not filing the 5,500. They're not doing the testing. What happens, if you're not doing these things?
Yeah. So penalties, lots of penalties. So July 31st is when your 5,500 is due. The prototype plans that you mentioned, and I was talking about before, especially I've seen this in a lot of the payroll ones where you'll get an email. They prepare it for you, but you have to sign off on it. Right. And you have to click a button. And if you miss it because you're getting bombarded with other emails that they send out for upselling you on every other product that they have, you're going to miss it. And then you have to file an extension. And if you don't file an extension, there's a lot of penalties, which I think they doubled or even 10x the amount of penalties in 2019 from 2019 in the Secure Act. So it's super important to do that. And not to mention, even if you shut down a plan, let's say January 1st or January 2nd of 2022, the plan is over. You decided to shut it down. And as long as there's money, you have participants maybe you can't get a hold of. If there's money in that plan, you have to continue to file those 5,500s every year until all the money's gone. And so if you shut it down on January 2nd of 2022, you have to file it in 2023. And if you forget, then there's the penalties, and you have to ask for forgiveness or pay a penalty, or there's a lot to it, and trying to DIY it is usually not the best way to do it, because you're running your business. That's your expertise, running your business, not administering a 401k plan.
Yeah, I know. I know lots of times people come to us and ask us to file the 5,500s form, and I try to explain to them, hey, that's a specialty, and I don't want to have anything to do with it. We'll keep doing the business tax return. We'll find somebody to help you file that.
Right.
Because the penalties are so high, when it comes to that. And I think it's sometimes people don't understand, well, why are these penalties so high? I'm paying my people and stuff. It's because you are doing things with someone else's money. Same thing with payroll taxes, and that's why it's exponentially so much higher. I don't want to make it sound like 401ks are negative or anything like that, because they're not. If properly implemented and compliance work is done, they're great. What are some of the things that I'm going to say the secrets to 401k plans that people don't really know about because they're DIYing it?
Yeah, and it is a vast world, and when you are trying to DIY it, you're reading articles, you're reading, listening to podcasts, and we're going to scratch the surface today on what I'm going to explain here. But the best way I explain this is kind of imagine an upside down 3-tiered cake. Okay. And this is the potential, right? So the bottom is your 401k. That's the 20,500 that we all know and love, right? And our goal is to maximize every layer as much as we can to be able to get you, I mean, well into the 6 digits of pre-tax contributions if you need to. So the bottom layer is the 401k. That's you as an employee of your own company, 20,500. The best thing you can do is a safe harbor, but a lot of people don't realize that there are multiple kinds of safe harbors. 9 times out of 10, we've been doing a QACA safe harbor, which is qualified automatic contribution arrangement. And a QACA safe harbor is, well, there's 2 things that we like about it. One, it has a 2-year vesting schedule, a cliff vesting schedule, which a lot of people don't like the safe harbors because it's an instant vest to the employees.
Right.
And then you also get an extra $500 tax credit out of it. But when you're under the umbrella of safe harbor, it bypasses some of those annual testing that we talked about. It allows you as the owner to max out regardless of what your employees are doing, because the IRS is saying, okay, you chose one of these pre-approved matching investing schedules. Check, it's fair. Now you can do whatever you want. That's basically the summary of a safe harbor. Now, moving up to the second level, that's the profit sharing or employer contribution. So you as an employer of your own business, it's coming out of the corporate account. This is profit sharing or the match. And believe it or not, what you do on each layer allows you to maximize the top layer and so on and so forth. So not to get into the weeds on how you calculate, but there's different gateways. And if you do this on the bottom layer, then you can add more to the top. But there's different kinds of profit sharing, so the prototype plans are probably going to let you do something called pro rata, which is not ironically, but it is basically calculated identical to a SEP IRA. Mm-hmm. So if you give yourself 25%, you give everybody else who's eligible 25%. And a SEP IRA is all employer contributions as well. So that's pro rata, that's turnkey. That's what everybody who picks up the phone and I talk to, they think, oh, that's what I have to do. And it's not. There's multiple kinds. There's age weighted. There's Social Security. So the idea is to move as much of that profit sharing towards your pocket and then minimize the employees if you can. And there's one we're doing one as we speak, and it's called new comparability profit sharing. And it literally allows you to segment out departments of your company and not offer profit sharing to everybody. And it's weighted towards the folks that you target. So it could be tens of thousands of dollars difference of contributions that you have to give to employees versus what you end up in your pocket. So, and we've, at the end of the day, when you're in business, everything's net. What is the net benefit? There's cost, there's administration costs, you're going to give some to your employees, but what is the net? If you're in the black on your tax savings, it's a win, right? That's the way we look at it. So yes, you're going to have to give some money to some of your folks, but let's try to maneuver as much of that over to you instead of giving away the pot to everybody else too. And that's just part of it. There's different kinds of safe harbors that we prefer to use because there's a 5% gateway, so on and so forth. I won't get too far into that, but the top layer, right? This is the big boy, if you will. And first thing we look at is the cash balance plan or defined benefit. And the defined benefit is basically a pension plan, like the old school, similar to the old school Ford, GM things that we don't really see anymore. And but they're coming back. They're becoming very, very popular because the contribution limits, and they become a little bit softer on the rules too. I think is another big reason. But if you're approaching retirement age, 60s, you're able to contribute over $300,000 pre-tax into these things, and there's a lot that goes into that. You have to bring in actuaries, which we use actuaries to calculate this, and how much do you need to give, but you actually will have to minimize your profit sharing a little bit in order to maximize. There's different, like I said, gateways in there, and we do all that. And at the end of the day, running numbers is step one. You got to run the numbers and do it ahead of time. So when I say, let's start talking about what you're doing with your income, let's figure out if it's worth it with your self-employment, especially if you're filing as an S corp. What do we increase your income? We talk to the CPA. What's the balance here, and is it worth it? What's the net? Are you in the black? And your tax, and if you're contributing 300,000, most of the time you're in the black on your tax savings.
Right.
But yeah, and then if that doesn't work out, there's other non-qualified options like deferred comp. We've done some deferred comp where when you say non-qualified, that means all rules go out the window, where you don't have to worry. You can target whoever you want. You can pull the money out whenever you want. Deferred comp is basically what you're doing is you're saying, I'm going to promise to, instead of this money I'm going to give to you now, I want to promise this to you in the future. You're deferring the compensation, and then all that money becomes taxable to the employee when they retire. And there's different ways that those are very high level planning options. But if you're making a good amount of money and you're netting a good amount of money, there are things above the 20,500 that you hear about every day.
Right. I like with my business is to get them to mix that 401k. And I typically say the 401ks for the employees, the profit share, the cash balance defined benefit is for the employer.
Absolutely.
That's kind of how I kind of look at it. With the 401ks, are you able to make after-tax contributions to 401ks?
So as an employee of your own company, you're able to do the Roth. So all employer contributions, whatever comes out of the corporate account, is pre-tax always. If you're doing, so you as an employee of your own company, you can choose the Roth option. And if you design it properly, and it's very difficult to do this when you have employees involved, but literal after tax contributions. And, a lot of people do the backdoor Roth conversions and
Right.
those kind of strategies too. The testing goes out the window. Any safety that you have with annual testing goes out the window when you kind of go into those. So it's kind of like it's if you're lucky enough to be able to pass testing when you do that kind of thing, it's a great option. But it's tough. Sometimes it's very tough to design those. And again, a census, if you give an administrator a census at CENSUS,
Right.
with certain pieces of information, you'll have all the answers very quickly, what you can do and what you can't do. But yeah, after taxes, usually on the employee level, not the employer level.
Right. So I guess going back, yes, you can do it, but you got to be careful in what you do and make sure you talk through it.
Yeah.
With the 401k plans and things like that, you're saying now it's like, hey, you really need to start acting on it fast. When do I have to have a 401k plan set up to be able to use it?
Yeah, good question. So in this case, so the safe harbor, for example, the deadline was 10/1. 10/1. If you want for 2022, for example, if you wanted to implement a safe harbor 401k, so you can max out your own as an employee of your own company, that was October 1st.
Okay.
Believe it or not, there's actually another kind of safe harbor that we can implement after October 1st. So the Secure Act opened this up in 2019 as well. And so we're actually implementing a few of these right now where you can do a 4% contribution instead of a match, but a 4% contribution, and then you can bring it back down to 3 if you need to in later years. But the IRS is saying, yes, you can, but we're going to make you give 4 to everybody who's eligible, regardless if they're participating or not. And so October 1st is generally the deadline, but they've extended it out a little bit. If you want to do any employee contributions, it's the calendar year. 12/31 is the calendar year for that. But if you want to do a profit sharing plan, again, it's which is employer contributions. So all the way up until you file your taxes, including extensions. So depending on how you file, September, October, you can actually do a contribution and get some money off the books for 2021 for this year. But obviously right now you don't have to worry about it until next year around tax time. And most of the time profit sharing contributions are done after
Right.
year end anyway.
Right.
You once you
Finding
know how
money.
much
How
money
much
you have
money do I
left.
have left?
Exactly. How do I keep up most of this? And
Right.
that's where we get into those profit sharing calculations and you can change those every year. You can make a change to your document anytime you want. When you're doing a plan, when you're doing a custom plan document, you're not doing prototype, you can do those things. And just being, not to mention the investments, I guess we should kind of bring that up a little bit. A lot of people think you're stuck to the investments inside of your menu. But when you're building out and you're the owner of the company, you can only have one 401k plan, right? But you can have multiple custodians inside of that plan. So what a lot of times we'll create the menu, the 2025 funds for the employees, but then we'll allow a brokerage arm or brokerage sleeve to where you can open it up and, you can invest in real estate, cryptocurrency, anything you want, anything that's allowed inside of an IRA, the self-directed IRA, you can add to it. The question is what custodian allows it? A lot of them don't like 401ks. They like IRAs, but
Right.
the 401k piece of it. And you kind of going back to the old school manual 401k where you're asking for manual reports every year. And that's when they kind of get fun, is when you can get into the manual old school stuff. So.
Right. So I think it's just really important to keep, because I keep seeing a lot of the reports that are coming out on 401ks that they're failing testing and things like that. And I think it's important, as a business owner, if you have a 401k, to make sure that all of your testing is being done properly, you're not failing, and then everything's being filed properly. I think that's
Yep.
something that's important, because you're signing your name, which means you're liable,
Yeah.
for it. So it's something to be careful about, to make sure that it doesn't come back and bite you.
Yep. You're acting as trustee for their money.
Yeah.
So making sure that it's done right. And if you don't do the safe harbor, that's where the annual testing, and that's where the failing comes in when you're not a safe harbor. And the plan design is very important when it comes to that, because you're failing in your employees, your highly compensated employees, which is 135,000 or more for this year. So if you have employees that are either own 5% or more, or 135, or a direct relative, so like a spouse or a child,
Right.
those are highly compensated employees, and they're held to the same standard as the owner. So if you fail us, then they're going to get a check back too. And usually your higher paid employees are not the ones who want to see a check come back.
No.
So the plan design is very important. We want to develop it and create the match that is incentivizing your employees to put more money in. And then also we have to, protecting you as the owner, making sure that vesting schedule is in place.
Right.
So if you have a lot of high turnover, then that money comes back to you. So yeah, you can mold these plans to a lot to how it fits your budget and how it really will protect you and benefit you as the employer.
Yeah. So I think like anything I preach on the show is planning, and making sure that you get with a professional that knows what they're doing to talk through all of this, to make sure that it is being set up the way you want.
Yeah.
And not, you think it's one way, but it's actually, it's not that way. So you got to be careful. So Matt, we've run through a bunch of stuff real quick here. What have I not asked you that you wish I had?
Well, I think that might take up a whole nother podcast episode, but there's just so many. The one thing I want to harp on is don't settle for payroll integration is usually the priority. I got to tell you, priority is payroll integration. I don't want to have to worry about sending the money in. It's 2022. Payroll integration is a lot easier these days. Then it's not just you have to go with this company because they offer it, or these are the integrations. Technology is pretty good. It's just lining up your custodian with whoever you need to, and there's multiple. So don't just go for the easy turnkey, because I've seen it a lot where you plug and play and it's easy, not necessarily the cheapest, but it's easy, but it's also very difficult to move when you start realizing there's issues on the tail end.
Right.
So a lot of headaches, but just being able to, just pick up the phone and answer questions or ask questions. We have people who we talk to and they're saying, okay, talk to us in a year and a half, 2 years, because they're not ready financially. That's fine, but you want to align yourself and make sure you're prepared, because sometimes just like when you're getting a mortgage, when you're a business owner, you have to kind of plan ahead with your tax write-offs and things like that. But there's a lot of planning involved.
Right. I think the other piece with that too, you're talking about, talking with people and being ready and whatnot. I also think that lots of times people, set it and forget it. So, to me, if I have a 401k plan and I'm, have somebody who's the custodian of it, to me, they should be talking to my employees, a couple times a year, or as on an as needed basis type thing. So they can give advice to the employees to make sure. So I think besides just talking with someone to set it up, make sure you have somebody that's going to talk to you and your employees to make sure that everybody understands what's going on and how their money is being moved around.
Absolutely. That's kind of a soft rule that I call it as the IRS. They want to see you doing education meetings. They want to see you doing enrollment meetings. They also want to, another soft rule is they want to see you benchmark every 3 years. And benchmarking is shopping the rates for your 401k and making sure your custodian and record keeper, because every custodian has a niche, and a lot of them like startups, but a lot of them like $1 million in there too. So you're gonna shift. Yeah, of course they do. But some of them are priced differently. And as you graduate, if you will, with higher dollar amounts, you're gonna get better prices and you can negotiate. It's not a hard dollar. So
great. So Matt, if people like what they've heard so far and they want to reach out to you, how can they get in touch with you?
Yeah, our website is 401k.expert. It's a pretty simple URL. So 401k.expert. We actually have a tool on there as well that if you aren't sure, this is a great way to start the conversation. Is get in there. There's a conditional logic questionnaire. It takes 30 seconds. It'll point you towards a few plans that may or may not be what you're looking for, but at least narrows down the scope, because there's so many options out there, and it gets you because if you try to learn about every plan, it's going to take you years. Yes. So yeah, just it'll help you focus in on a few, and then it comes down to how much do you want to save is the final question, and then that'll get you down to at least one or maybe two options out there.
Okay, great. I really appreciate your time and your knowledge on 401ks, because I think it's something that as we go and look at Social Security maybe or maybe not being there, people really need to start saving on their own.
Yeah, it's clear that they want you to save. They want you to save into the 401k.
Exactly. All right, thanks, Matt. I appreciate your time.
Gary. Appreciate it.
Sure. So this week our guest was Matt Ruttenberg, who is the CMO and shareholder of Life Inc. I'll see you guys next week.
This show has been produced by Market Domination, LLC. To discover how you can have your own show completely done for you and turn it into a real published book and become the authority in your marketplace, go to www.marketdominationllc.com/podcast offer.